Recessions usually announce themselves with layoffs and panic. This one showed up more quietly. A paycheck that barely outruns prices, a mortgage quote that still starts with 6, and an economy that technically grows while households feel pinned. Officially, the U.S. is not in recession, but parts of everyday America are already living like it is. You see it at the kitchen table level. In February, disposable personal income fell 0.1%, while personal consumption rose 0.5%, which means families kept spending even as their after-tax income slipped. Real spending rose only 0.1%, and the personal saving rate sat at 4.0%. Real average hourly earnings were up just 0.3% from a year earlier. Housing is no relief either. The 30-year mortgage rate averaged 6.30% in mid-April. Existing home sales fell 3.6% in March, and the median existing home price reached $408,800. That is what a lived recession looks like. Not collapse, just constant pressure. This did not start with one dramatic event. It started when the inflation shock of the last few years faded too slowly, so borrowing costs stayed high and relief never really reached ordinary households. By February, the Fed's preferred inflation gauge, PCE, was still up 2.8% from a year earlier, with core PCE at 3.0%, still above the Fed's 2% target. Growth never fully broke, but it clearly lost altitude. Real GDP rose just 0.5% at an annual rate in the fourth quarter of 2025, and the average of GDP and GDI slowed to 1.5%, down from 4.0% in the prior quarter. Think of the economy like a shopping mall where every store pays a different version of rent tied to interest rates. When money stays expensive and households move less, borrow less, and carry more strain, builders hesitate. Small firms delay expansion. Employers stop hiring aggressively because they do not trust future demand. The Fed's April Beige Book said many firms had adopted a wait-and-see posture. Housing softened in several districts. Demand for temporary workers rose, and many districts reported consumer financial strain. Meanwhile, household debt climbed to $18.8 trillion in the fourth quarter of 2025. That is how a slowdown spreads now. Not like an explosion, more like the lights dimming room by room. And once that process starts, the averages can hide the damage. March payrolls rose by 178,000, but the BLS also said employment had changed little on net over the prior 12 months. Unemployment held at 4.3%, yet the number of people unemployed for 27 weeks or more was up by 322,000 over the year. The Conference Board's leading economic index fell 1.3% over the 6 months through January. Then preliminary April consumer sentiment dropped to 47.6. Translation: the economy can still be upright while hiring appetite, confidence, and household resilience keep weakening underneath it. The common mistake is asking, are we officially in recession yet? That is the wrong question. NBER does not use the lazy 2 quarters rule. It looks for a significant, broad decline in economic activity using measures like payroll employment, real income, real spending, sales, industrial production, GDP, and GDI. By that standard, the U.S. has not clearly crossed the line. But that is exactly why so many people feel like the headlines are missing the story. Some higher income spending is still resilient. Some investment, especially around data centers, is still strong. Aggregate growth can stay positive while rate-sensitive sectors and ordinary households already behave like the downturn has begun. First, Treat liquidity as your real defensive asset. Build or protect a cash buffer that covers your essential bills, because weaker hiring hurts people before the headlines fully admit it. Second, attack the debt that punishes you fastest. In a slow-growth, still high-rate environment, expensive revolving debt becomes deadweight, so payoff speed matters more than trying to outsmart the market. Third, stop making major decisions based on hoped-for rate cuts. If a house, car, or refinance only works in a much cheaper rate world, it does not work yet. Run the numbers at today's conditions. That is not pessimism. That is discipline. The danger is not that America wakes up tomorrow to one dramatic recession headline. The danger is that millions keep adjusting downward. One bill, one delayed purchase, one weaker job market, one smaller margin at a time, until the slowdown becomes too broad to ignore. The Fed's own regional reports already show more strain, more caution, and less certainty. And by the time recession becomes official language, it is usually no longer early. It is just obvious.